All right, welcome to this explainer. I'm officially throwing on my whistle and stepping into my role as your personal financial coach today because we're tackling an absolutely crucial part of your financial game plan, where you actually keep your cash. Most of us just default to whatever we've always used. But today, we're running a full scouting report on your options. We're going to break down the traditional banks, the credit unions, and the rookies on the field, the neobanks, to see who actually deserves to hold your hard-earned money. So let me ask you a question, and I want you to be brutally honest with yourself here. Is your childhood bank actually costing your money? It's so common, especially for young adults, to just stick with the exact same checking and savings accounts open for you when you got your very first paycheck at age 15. You keep it out of pure convenience, right? Because changing it feels like a total hassle. But letting financial inertia bench your savings, that is a classic rookie mistake, and it could literally be eating away at your wealth. So, let's start our tape breakdown by looking inside traditional for-profit banks. The massive heavy hitters like Chase or Wells Fargo. Okay, let's dive right into how these guys operate. At its core, a traditional bank is a business. It's a for-profit enterprise owned by investors. When you drop your money into a checking or savings account, the bank takes that cash behind the scenes and uses it to make loans to other people or businesses. They make their money off the interest from those loans, and you get a tiny slice back as interest on your deposits. Now, I know that might sound a little sketchy at first, but it is a completely standard practice. And the most important part, your eligible funds are insured by the federal government up to $250,000, so your money is safe. And hey, there's a reason these national banks dominate the market. They offer some massive perks. First off, the convenience factor is just off the charts. We're talking huge networks of branches and ATMs basically everywhere. If you travel a lot, that's a huge win. Second, they're a total one-stop shop. You don't just get checking and savings, you can get brokerage accounts, money market accounts, small business loans, the whole shebang under one roof. Plus, since they're massive corporations, they've got the budget to roll out the slickest, most high-tech mobile apps super fast. But what if you're not exactly thrilled about funding investor profits? Let's shift the playbook over to the credit union cooperative and see how the other side operates. Look at how distinctly different the structure is. A credit union is a not-for-profit cooperative. So instead of being owned by some distant Wall Street investors, it's actually owned entirely by its members, meaning you. The absolute key takeaway here is that a credit union's main goal isn't to generate shareholder profit. It's to help its members succeed financially. Instead of siphoning money up to the top, any profit they do manage to make goes right back to you through things like financial education programs, incredibly low fees, and honestly, significantly better interest rates. Now, I'm going to keep it completely real with you. There are a few potential hurdles to joining this team. Unlike a traditional bank where you just walk in off the street, credit unions usually have membership requirements. You might have to cough up a small membership fee. Sometimes it's literally just $5 to get your foot in the door. They're also usually community-based, so you might have to live in a specific town or work in a certain profession like the military just to be eligible. And, well, because they are smaller, you might find their mobile apps are a little clunky, or they might not offer super complex commercial loans. But hold on, let me bust a massive myth right here. People always think joining a credit union means you're going to be stranded without an ATM the second you leave your hometown. Absolutely false. A ton of credit unions are part of this shared co-op network. This gives members access to over 30,000 surcharge-free ATMs and over 5,600 shared branches across the entire country. Honestly, that rivals, and sometimes totally beats, the big national banks. All right, so we know the players. It's time for the tape breakdown, head to head. Let's see exactly how these two match up when it comes to your daily money. Now, what's really interesting about this matchup is how clearly it highlights your daily costs. Just think about the fees. Traditional banks are practically notorious for slapping you with higher maintenance and overdraft fees. Credit unions, generally far lower or even zero fees. And look at the rates. Because banks are feeding their investors, they usually hand you a much lower APY on your savings and hit you with higher interest if you need a loan. But credit unions frequently offer way better returns on the cash you save and significantly cheaper rates for borrowing. Seriously, if you're thinking about buying a car anytime soon, that loan rate difference alone should have your full attention. But hey, the game has changed. We can't talk about modern finance without checking out the tech disruptors. Enter online and neobanks, the rookies totally complicating this traditional choice.
So a neobank isn't actually a chartered bank on its own. Instead, it partners up with an existing FDIC-insured bank to offer you checking and cash management. But here's the genius part. Because these online and neobanks totally ditched the expensive brick-and-mortar physical branches and the staff needed to run them, their overhead is incredibly low. And they pass those savings straight to you by offering wildly competitive annual percentage yields, or APY, on your savings. If you are totally cool with never walking into a physical branch to talk to a human being ever again, these are massive contenders for your cash.
Okay, we've reviewed the tape. Now it's time for your ultimate 5-point playbook. Let's look at the actionable steps. Take a mental screenshot of these steps. When you're picking a spot for your money, run through this list. Number 1, evaluate all account fees. Check what they're going to charge you just for keeping the account open or using an out-of-network ATM. 2, check branch and ATM access. Do you actually need a physical building, or is a good app enough? 3, assess the financial services you need. Just checking, or do you need a brokerage too? 4, compare those APY interest rates. You got to make your money work for you while it just sits there. And 5, this is absolutely non-negotiable. Always, always verify that they have FDIC or NCUA insurance. Got to keep it safe. And this brilliantly illustrates how it plays out in real life. I hear the exact same excuse all the time. But coach, it is just such a hassle to switch all my automatic billing info. And you know what? Fair. It is. It's a mild annoyance to go in and update your Netflix and your electric bill. But look at the payoff. In the source material we analyzed for this explainer, there was a real person whose childhood credit union merged, suddenly started dinging them with $3 out-of-network ATM fees, and slashed their interest rate. They finally dealt with the mild annoyance of switching, and boom, they found a new spot that completely eliminated their fees and literally tripled their APY. Tripled. That is a major real-world financial payoff for, what, an hour of clicking around on your laptop? This thought right here captures the exact mindset shift you need to make. What worked for you a few years ago might not work today. Let's just be completely real for a second. It is so incredibly rare for a bank to offer you any actual loyalty perks just for hanging around for a decade. Your life evolves, your financial needs evolve, and the market definitely evolves. You simply cannot afford to be blindly loyal to a corporate entity that isn't actively earning your business every single day. Do not be afraid to jump ship. Which brings us to one final critical question. Are you getting what you want out of your banking relationship? Seriously, pull up your bank statements this week. Take a hard look. Check your APY, hunt down any of those sneaky hidden fees, and decide if your current institution is actually earning its starting spot on your financial team. You've got the playbook now. It is time to make the smart trade. Thanks so much for hanging out with me for this explainer, and I'll catch you next time.